All right. Hi, good evening, everyone. So my name is Ming. I am finance analyst and trainer in Usmart. And for the past 7 years, I'm actually a full-time trader. And now I'm ventured into the education field. So I hope to share with you all my experience and maybe some knowledge about trading in the markets. I used to trade Forex, stocks market, cryptocurrency, and also use automated trading strategies like week trading to allow me to get a quite roughly consistent profits in the markets. So today I will share with you all how retail and the institutional traders operate. So we need to understand about what traders we are fighting with, because in the markets there are few participants, whether institution, retails, and also governments. So in this case, in today we will discuss about what is retail traders and how they operate, and what is institution traders and how they operate. And then we learn about the secrets of the institution traders, how they do their trades. So stay with me until the end, because this is I think can be considered a secret, because many people didn't trade like this. So you will get an idea on how those institutional traders trade the markets. And before that, I thanks and welcome everyone for coming to my sharing sessions today. All right, so let us start our sharing. Start my sharing. Okay. So the title will be how to think like a pro trader, like an institutions traders, because for retail traders, it's normally like us, retail traders, like normal people like us, like trade ourselves. So we always fight against those institution traders. So we need to think like them. We can consider them as a big shark. So we need to think like a shark, and how can a shark win the markets? So in the markets, there are normally two types of participants. And as the title said, one is institutions traders, and they are the professional traders on behalf of the big organizations such as banks, mutual funds, and pension funds. And there are another one like us, which is retail traders. And they are individuals, investors, or traders for personal account. So today we will try to understand the difference between the retail and the institutions traders. So for institution traders, the big difference is they trade very large volumes. They handle a lot of big cash. They handle lots of cash, and they need to execute a big lots in the markets. So they trade the markets differently, and they access to many advanced tools and market data. So their information is very up to date, and probably they can get a maybe first-hand or second-hand market data. Normally, if compared to the retail traders always get the news or information last, because we only get the news through maybe the media, the newspaper, and all social media, which is, we can say that it's the last hand already. So the information's war between institution and retail traders, we retails will always lose. And institution traders, they employ a lot of analysts and experts. So from here, is actually we can know that the institutional traders had a lot of the win rate is very high in the markets. And when they put a lot, when they are being put the orders, they got a very high market influence because they got a lot of cash on hand and they can make a big impact in the market. So for retail traders like us, we only trade smaller volumes. And then we got limited access to tools and data. And we also operate independently or with minimal support. So to become a retail traders with a very high win rate actually is considered very hard. It's not that we cannot success, but the odds towards us is very low because we are fighting against those professionals and those insiders, and we need to think out of the box. Like we need to think like institution traders and how they trade. And we got low market influence because when we buy a stock, we can't pump the stock's price, right? Because our volume is very small compared to them. So there is advantages of being retail traders or being institution traders. Let us discuss about what is the advantage of it. So for institution traders, they got economies of scale. Means their trade actually, they can use the cash to do a trade that is more cost efficient because they got lots of fund to move the price towards their favors. And they got a preferential shares, preferential access to market informations. Other than that, they also has a lower transaction cost due to bulk trading. And their commission is very low and they can do a very fast, high frequency trades. As for retail traders like us, we are very flexible in decisions making because when we buy a stock, we can buy it on this seconds and then we can sell it on the next minute. But for institution traders, because they need to put a lot of big orders, so they need to plan for a long time because they can't buy the stocks at one go. They need to separate their funds, maybe like towards different batches, many batches, and then they buy at a different timing, or they slowly accumulate it without people noticing. So to accumulate stocks, actually institutions traders is kind of very hard to execute it. They need to plan and it takes a long time for institutional traders to get them to load up their stocks. And compared to retail traders don't have regulatory pressures to justify the trades. Retail traders like us can buy any stocks we want. However, for institutional traders, they need to report to their heads, to their managers before doing any decisions. So they need to follow the regulatory system closely. They can't buy whatever they want, and then they can't just dump the stock price whatever you want. They need to have a plan to execute the plan. They have a plan to execute the plan, yeah. And for retail traders, we got abilities to act very quickly on the market trends. Means because we buy a very small lot compared to the institution traders, when things get wrong, so we can get out very fast. However, for the big traders like institution traders, they can't exit in the short term of time, right? So there's a pro and cons for these institution traders and retail traders. Next will be the challenges. So for institution traders, they got a risk of impact due to large trades. All right, because they buy a lot of trades, that buy a lot of size. The size is very in bulk size. They buy the stock in bulk size, and they got a very high compliance and regulatory requirements, like I said in the previous slides. And for retail traders, we got a limited access to advanced tools and data. So we don't have the information. So anyone heard about what is sell or news? So usually when the QR reports pump before the QR release, usually they are pumped by these institution traders because they got the access of the market information earlier than us, retail traders. So by the time the retail traders know the news, actually the stock price already priced in. So the first rule for retail traders is do not chase high, especially after news, right? So sell on news never goes old. Every time happens, every time is the same, unless the stock price didn't went up after the news beforehand after the news release, right? So when you see a good news come in, so usually you will get up a lot. Then you need to look back. Does the stocks goes up beforehand or not? Because if it goes up beforehand, there is a very high chance the stock price it will sell on news. All right, so we as a retail traders, we need to avoid this I think very common traps set by institution traders. And we got a higher transaction cost, mean high transaction fees per trade. I think if you are not not so high, you are not a high frequency traders, I think it's still okay. If you do a swing trade, I think the transaction cost didn't really affect your trade capitals much. And for retail traders, because we don't have a very specific and very close, I mean, very up-to-date information or insiders news. So we tend to very emotions towards our trading, because even you looks good at this stock price, when there is a lot of negative news around, we tend to like our emotions will follow those news, and then we do a very stupid mistake or do a very stupid trade, like maybe cut low, buy high, and do all these stuff. So for retail traders, we need to have a very specific plan before we enter the markets. And we need to have a strong mind to avoid us from letting those news manipulated by institutions, because they want us to go wrong so that they can profit from our cut loss. So the idea is, because market, always remember, market is a zero-sum market. It means when you lose, means you cut loss. When you lose, who will earn? The other people against you will earn. So it's a cycle. When you earn the money from the people, that means there are a lot of people lose money. When you earn big money, there will people lose big money. So it's a place that are transferring the wealth all around the world. It's just like a big casino, to be honest, for me. And we need to have our own strategies to become a good professional gambler. I mean, professional trader. Just a joke. So we need to know our edge in trading. So the strategies matter. And later, I will discuss with you all the trap that traders set for us, the retail traders. And I hope that this knowledge, I think I didn't mention much in the slide in the title because I'm not sure because not many people know this strategy. And when a strategy is known by many people, usually it does not work that good already. It does not work that efficiently. If everyone learn how to know how to use MACD, then the MACDs will go wrong. If everyone knows how to use the EMA, like the technical indicators EMA, then the EMA strategies will go wrong. Because majority people will lose in the market if you trade. All right. So this is the difference between the institution traders and retail traders. So lastly, I will talk about the market impacts for institution traders. They can move markets with large trades. So when we as a retail traders, we hardly move the price. No matter how, because you don't have enough fund, their funds can go up to billions. So if you want to move the market, the stock price, you need to have a lot of cash on hand. And only institutional traders can do that. We, no matter how we buy with a limited capital, we could hardly push the stock price. So it is wise that we as a retail traders try to move along with them. And for institutions, they often involve in price discovery. It means they can pump the price into price discovery area, which is all-time high. They can keep push until their target reach, and then they will start to plan the distributions, put a lot of news, and then you buy at high. Retail traders jump in and buy at high, and then they slowly will sell those stocks on hand to retail traders, and then retail traders will buy at high, and then it drops. The institution traders maybe buy it back again, and they will keep on repeat until retail traders goes broke. So for retail traders, we usually had a minimal market impact. And the good news is we are very reactive to market movement because, and it can be also a bad news because sometimes due to emotions, the institution traders, sometimes they make the stock price drop a lot in one day, and then retail traders will move according to their emotions, and then they sell at low. Then institution traders will scoop all the orders at low, and then it suddenly do a V-shaped rebound. So this is very common in the markets, in stock markets, forex market, crypto. They usually do that in order the retail traders trade at the wrong directions. So how can we trade with institution traders? Later, I will share some examples, especially trade technical analysis examples that institutions traders like to use. So we can learn on how institution traders trade and why they have such a high success rate and how they manipulate the markets. So this is roughly an idea, and actually this is not a very beginner trade guide already. Maybe it's like intermediate to professional trading guide, but I would like to share with you all so that maybe you all can spark some ideas at how to really trade the markets. And this knowledge you can hardly find outside because I think it's very hard to find this knowledge outside. So I decided to share with you all based on my past experience, and hope for you all, and also thanks for you all, even though not much people like join my sharing sessions. I just hope that these few people can benefit from my sharing sessions, especially the strategies later, and then can increase your winning rate very high in the markets. So comes to the strategies, which is the main point today. So how do institutional traders trade? So usually they'll do the portfolio management, hedging, and they trade based on liquidity trap. So they use smart money concept. I think many people, maybe you all can search at the YouTube, what is smart money concept? And overall, they trade based on liquidities. They set the traps and then they trade the traps, trade against the trap. So what is liquidities? Liquidities in layman terms, it means retail traders stop loss. Think like that. Institutions traders, they need to load a lot of orders, right? They need to load a lot of orders. However, they cannot accumulate the orders at one go, because when they accumulate the stocks at one go, the price will jack up, and then retailers will notice the volume spike, and then retailers will notice and jump in together with the institution traders. So institution traders will set a lot of trap in the markets, means they will break the support, and then the retail traders will panic sell. Then institution traders will load the price at those panic sell area, and then so that they can load a lot of stocks without moving the price a lot. And then retail traders will not notice they are accumulating. So this is the concept. Imagine you need to buy a lot of stocks without letting the price to goes up. What you need to do? You need to set a trap. You need to create a panic sell for those retail traders to cut loss. When they cut loss, it means they cut at cheap price for the stocks, and the herd, usually retail trader is a herd. They will follow, one people cut and then many people will follow, and then the institution traders will put a lot of orders below, and then it will, when panic comes, they will accumulate the orders without moving the price. Understand? While getting a very cheap price on average. So they will keep on doing this until they accumulate enough, then they will do a breakout, and then they will do a significant uptrend. So we need to know the area where the liquidity stays as a retail traders to follow institution traders. And institution traders, they usually trade high risk to reward. So for retail traders, we always trade risk to reward like maybe 1 to 2, 1 to 3. For institution traders, they actually aims for 1 to 10 or 1 to 20 or above. They risk 100 to earn 2,000. They risk 100 to earn maybe 3,000. This is their risk reward range. But today I will not touch with this because this actually involve very deep knowledge. I think a professional trader's knowledge already, institution trader knowledge. Maybe it's not. I don't think it's something that I can share around that much. So we can touch with it and maybe give you all some brainstorming about how institution traders trade. And institution traders usually trade with minority in the markets. It means remember in the markets, only 20% of, or maybe 5% of people win the markets. So if you want to become the winners, you need to stand with these 5%, right? And institutional traders, they will always trade at a minority. They always stand with the minorities. So they always have the high win rate. First, because they had good information or insider information, and also they always buy at the liquidities. They always accumulate at the liquidities. We can say that markets 80% of the time they are sideways, and then And then this is the trap set by institutional traders, and then they will maybe do breakout at the both place, and then in the end it goes the true directions. So they do a sideways is because they want to build the liquidities. It means they build liquidities is the sell loss of the retail traders. So retail traders will put a lot of stop loss, and then they get all the stop loss, and then the market move to in the opposite direction of the retail traders. So I'm not sure if you all trade or not. If you all notice, you always cut at a low, and then the markets do the opposite sides. So this is why you always face this problem. It's because this is the true natures of the markets. All right. And for retail traders, they do day trading, swing trading, or even scalping. And as a retail traders, we trade based on common technical analysis, which is retail concept. What is the common technical analysis? I will share with you all in the upcoming slides. Okay, if you all have any questions, you all can ask me, and don't be shy. I just share maybe all this knowledge is very technical, and I hope you all can understand the concept of institution traders, how they manipulate the markets, and how we retail traders can ride with them. How we retail traders can, what we as a retail traders can do to increase our win rate. So to recap for this, retail institution traders always trade based on liquidities. They always trade based on retail's cut loss. It means when we got people's cut loss, they will get a chance to accumulate at low, right? They will get a chance to accumulate at low and without moving the price. So we won't notice they are accumulating the price. We won't notice that they will accumulate the stock price. And retail traders, as usual, always trade with majority and always buy high, always chase high. They won't chase low, they won't buy at low. And when they buy at low, it can go lower. Why is it? So we need to discuss about how and why this is happening. All right, next, I will talk about the retail chart patterns. This is the normal retail concept, retail chart patterns concept we learn. I think outside the markets is very common, double top and double bottom, right? So for double top and double bottom, we usually place an entry on the breakout, and our stop loss will be the double top or double bottom, right? And then the targets will be above the entry. So this is the very common retail chart patterns. And I know that many of people trade this. And this is the very famous patterns among retail technical trading. Next will be the bullish breakout, entry, stop loss, and buy, and the bearish breakout. So it breaks the resistance, and then we do an entry, and the stop loss will be the previous low, and the targets will be maybe for retails is 1 to 2 or 1 to 1.5 or 1 to maybe 3x max. And then for breakout, when it drops and it breaks the strong support, place an entry. Your stop loss will be above the breakout, will be the swing high of the breakout, and then the targets will be maybe 1 to 2 or 1 to 3. So this is the common retail chart patterns. And then I will show you all what is the retail, what is the institution chart patterns later. Next, the famous retail chart patterns will be the head and shoulder. I think this is a very common one. I think many people use that. and you buy at the breakout of the neck, and then you do entry, you do a stop loss, and then for the head inverted, the right side will be the inverted head and shoulder. Your stop loss will be the nearest swing high, and you buy at the breakout, and your targets will be below the entry when you are shorting. So head on shoulders is also a very famous retail chart patterns. Next, the very famous one will be the break and retest concept of retail chart patterns. I hope you all, maybe you all can consider to screenshot all this, because sometimes it takes times to like process all these chart patterns if you are very new in technical analysis. All right. So for the famous one, break and retest, you break previous very strong resistance, then you wait it, you break the previous very strong resistance, then you wait it to come back to test the previous strong resistance, become supports. Then when it breaks out again, you make an entry and then you put a stop loss at the low, at the resistance become support area, and then your target will be upside. And whereas for the short break and retest, it breaks the strong support, then it retests, then it breaks the new high, then you make an entry there, and the stop loss will be above, then the entry will be below. So this is how the famous retail break and retest concept. So why I discuss this famous retail chart and patterns concept. So here I discuss this is because when you trade like this, in the long run, sometimes yes, because the markets, the institutions, they are plotting those retail chart patterns for you. Sometimes you look back, yes, it can trade, but sometimes it didn't hit your TP, then it goes it goes the opposite of directions. It means that most of these retail chart patterns is building liquidities for them. You are putting the stop loss that everyone knows, right? Because all these famous chart patterns you can learn everywhere. Every people knows. Remember, in the stock markets, it's a zero-sum game. You win, people lose. You lose, people win your money. So this concept already known by lots, I think, most of the people outside the markets. If everyone use this concept, why everyone is not a successful traders, right? Because only 5% of people will only success in trading. So we have to go against them. We have to understand how most of the retail traders think. So the knowledge you found outside actually is manipulated by a big shark. They want you to trade like that in order sometimes they let you win. Sometimes in the long run, eventually you will lose. This is like the gambler and the casino. They open a gambling class and teach you how to gamble, and then you use the gamble method. Sometimes you can win, sometimes you lose, and then in the long run, you will lose everything because they want you to trade like that. So this brainstorming, I hope you all get the idea, because this is a secret. I mean, not much people know. And because today there's not many people here, so I try to share my professional knowledge and how institutions traders trade. They trade against your strategy. When you put your stop loss or the stop loss there, everyone knows. You put the double bottom stop loss at below, everyone's know, right? Sometimes it can move up maybe a bit, but if you don't take profit, then it suddenly go against you. This is why it's always happen in the markets. And we need to alert that in trading, it's not that easy. It's the hardest way to earn easiest money. Trading is not that easy. Always remember that. Only 5% of people win. So if you look outside, there's a lot of guru. They actually learn a lot. And they actually earn a lot in selling courses. They could hardly like trade, like they will hardly profits, had a long-term profits with trading. Investing is another thing. Investing have a higher win rate because we ignore all those um, uh, operator, sharks, institutions, noise. All right, today I just focus on this this trading. How can we trade along with these institutional traders? So I discussed with you all these chart patterns, and this is the famous pattern. Just remember that if you trade using these common and famous chart patterns, you will become the liquidities. And remember that institutions, they trade your liquidities. They cut your loss, force you to cut loss, and then they will get your orders at much cheaper price. Then once you cut loss, the price will move against your directions. So this is always happen in the market. So we need to have an idea how to become the minority in the market. So first, very easy, we don't trade famous chart pattern, retail chart patterns, but we need to understand the retail chart pattern first, because we need to identify where is the sell loss. Because sell loss is the liquidities. Just remember that. In the market, we always need to buy at the area that many people will cut loss. All right. So I had discussed with you all breakout bullish, breakout bearish, head and shoulder, inverted head and shoulder, retail entry patterns, break and retest, long break and test, bullish break and retest, and bearish break and retest retail entry patterns. So you all need to have a good understanding about these market patterns. Then I will show you the patterns, how we can trade against it. All right. Actually, this is not a very, I think, not a beginner's trade, but I just want to share with you all. Maybe next time in futures, you all can look back and you all can see and study the markets with this different concept, because normal concept outside there, that very common one, had actually very low win rate in the long term, in a big sample, I mean, in the long term trading time. So before I go into next slides, anyone have any questions, you all can put it down. So you all can put it down, and no questions? No questions, then I will continue. All right. So next I will talk about these institutions chart patterns. Double top, double bottom, DB is double bottom, and double top or double top breakout. So for the left side, you all can see there's a red words retail, which is this the retail. Normally retail traders will put the entry, sell loss, and the DP there. So here you can see that retail will put the sell loss at the double top, because they say double top is a very strong resistance, and they will put the sell loss there, and then when there is a breakout, they will make an entry at the breakout, and the target price will be below the entry. So here you can see the markets, the stop loss is double top, so your cut loss is there. Remember, you just focus on your sell loss first. Your cut loss is the liquidities, and institution traders, they will target that to get a cheaper orders of yours. So it build the traps. They will always build the trap. They build the trap, then you entry at the double top, then they build a breakout, then you put your orders. Then usually if you TP fast with a low risk reward, like maybe 1 to 0.5, 1 to 1, maybe you still can profit. But sometimes it just went 1 to 0.3 something, it breaks out a while, then it suddenly reverse up all the way to target your stop loss. So this is how the traps set by the institutions against you as a retail trader. And it's not that easy to understand at the first sight, and I hope you all maybe can screenshot and then you all choose 1 or 2 favorite patterns, like maybe double top, double bottom, you all just practice these trap models. Then it's not that easy in trading. Then you need to apply or backtest the markets by looking at these market structures. So in trading this type of institutions patterns, you actually need a lot of studies to understand the pattern. It's mainly on the chart recognition, chart pattern recognition, right? All right. So next will be the double bottom breakout. So for the double bottoms for retail traders, it means that the double bottom, there's a lot of strong supports, right? So the common knowledge outside there, the retail knowledge outside there is the double bottom is a very strong support. So many people will put the stop loss below there. So you know there will be the liquidities. There will be liquidity. So when the institutions they make a breakout, it breaks above, many people will make entry and put a stop loss at the double bottom. Then the market usually will move, suddenly goes opposite directions and take your stop loss. So we need to recognize all these patterns and we need to be aware. You can trade the potential double bottom, but if you didn't get out at the time, but we need to bear in mind that in futures, the price will come down to take those double bottom. It means liquidity hunts by the institutions. All right. So this is double bottom setup for the institutions chart patterns, and I think not much people actually know this pattern, know how to trade like this. So I'm not saying that all this pattern is 100%, but you need to take this chart patterns and practice it and keep looking back at the stocks, because you need to do hard work in order to become a professional trader. So I just share an idea with you all that you all can trade like that, because in trading there's a lot of strategies. There's also the retail strategies that success, but for me I'm looking at a bigger time frame. So I will always look at the bigger liquidations hunt, bigger traps. So in order to like get a very good swing profits. All right. So next will be the chart patterns of bullish breakout. So for the left side, you all just look at the red words, which is normal, common retail traders, they will entry based on this. They will put a sell loss and then entry as it break out, and then the TP at the top. Then when it break out, it suddenly it drops back. It drops back, it takes your sell loss, and then it goes up again. So this is a common bullish breakout patterns in the markets, and we don't directly trade the breakouts. We wait it breaks the most people's cut loss, and then it goes against the directions. If your high time frame is bullish, So we need to understand the high trend, but this is another more advanced stuff. But until now, we just focus on these chart patterns. All right. So remember, the institutions, they always goes for a retail sell loss. You need to have a patience to wait the nearest retail chart patterns to get liquidated. Their sell loss get liquidated, and then you see is there any bullish candles like forming back up again. Then you make an entry. Sorry. So another one is the bearish breakout. So for the left side, you can see common retail traders will put entry, sell loss, and TP like that. And then the sell loss will be there. Then when you do entry, it breaks out. Usually it didn't hit your TP, and then it reverses all the way down, take out your stop loss, then it moves towards your direction again. This is why you always get hunted, get cut loss, and then the price moves towards your directions. It's because you are using retail knowledge. Remember, we don't follow retail, we don't follow majority. And then you all are lucky because this knowledge is very hard to find outside them, because only minority of people knows this. And I hope I can bring some value to you all, even though might sound very technical. And then, as I said, if you want to success in something, you need to study. This is not a play stuff. I mean, it's not a kid. It's a hardworking stuff. You need to put a lot of efforts to become a successful traders. Then next one will be the famous one, head and shoulders. For the left side will be the common retails entry. The sell loss will be there, the entry TP. And for retails institution, they will take your TP and then reverse up. All right, because for this will be the inverted head and shoulder. And then, no, I mean for this is a head and shoulder, which is the bearish one, bearish chart, retail chart patterns. And then here it do a reverse directions. Then for the institutions chart pattern inverted head and shoulder, for the left side, you can see normal retail traders will put the entry sell loss there. Then this time, the retail, your institution, they'll break your entry. Then you reverse all the way up to targets your sell loss, because your sell loss is a liquidity. It either target your sell loss first and then goes the directions, or it targets the towards the entry first, then goes all the way to your sell loss. So all this you just need to pick one or two famous chart patterns that very easy to understand. Then you keep on practicing this. In trading, we don't trade around everywhere. We just trade based on what we know and what we see and what we confident with. And the confidence comes with, you need to backtest a lot. You need to experience live trading a lot. Then eventually you'll build the confidence in it. Then lastly is the famous break and retest chart patterns. So for the left side will be the common retail traders. They will put their entry there, their sell loss there, and the TP above. Then this institution traders, they will do a breakout. Once the breakout, it immediately reverse down and then to target the sell loss. All right. So you all can just pick screenshot and pick few favorite patterns, and then you all keep practicing it. For me, for the starter, I think double bottom or double top is very easy to start with. All right. So for this break and retest bearish break and retest. For the left side, you can see the common retail traders, they'll put entry and TP and sell loss there. And then the breakouts, once they do a breakout, then it suddenly reverse down, reverse up to take retail traders sell loss. So we need to trade against the market. All right, so this is the few institution favorite chart patterns. They like to trade against the retail traders. So remember, just always ask yourself, how many people will put the stop loss there? Is this the common chart patterns? Is this the common technical analysis that you can find outside? You need to be aware of that because you can be the liquidities. If you can't see the liquidities, you are the liquidities. We need to find the liquidities, the spot, and then we need to wait until it drops below that. Then you need to see and it got moved up back towards your direction or not. So this is roughly the idea of how institutions traders trade. They use all these chart patterns against the retail traders. And I hope you all did learn something today. And I think this is my sharing today. Anyone have any questions? Let me see if you all have any questions. No questions? All right, I just share, for starter, I think you all just focus on this double bottom, double top patterns because double bottom or double top is a very strong resistance. Remember, if you see a very strong resistance, eventually in the future it will get hit. It will goes up. What's the percentage or what to look out for the gap? Um, okay, about the gap, Jake Gore, I think your questions with the anonymous attendee above is the same. I have the question about the gap. What's the percentage or what to look out for the gap? What you means by the gap? You means when the price suddenly jumps gap or what is the profit you want to take the area? I'm not sure about what you means by the gap. Is it the price like maybe when when the price when the stock market opens the price gap up or what is means by the gap? Hello, Jake Gore. The retail stop loss guess where okay we will never know the retail stop loss gap because um sometimes like let's say the stock is $1, your cut loss is maybe 80 cents and your target is maybe $1.10 whatever. The if you put the orders at the very common chart patterns, the retail traders, the institutions will hunt these liquidities. When you hunt liquidities, it really depends on the markets because the retailer, the institutions, they can hunt very deep until no one is interested in the market. So we always need to monitor the area. We don't jump in. We don't guess how deep it will go. We need to wait it drops. I mean, maybe the orders is very big, right? They cut everyone do a deep V, then everyone gets stop loss. Then when we see at the low time frame, maybe like in stock market we use 5 minutes or 15 minutes, then you'll see it drops. you can feel it during it breaks the market and it breaks the stop loss. You can see the markets can suddenly become very active because it means that many people had get stop loss very active, and then many people panic very active. You can see the jump, the price like keep flashing, the bid, the very active, the song. Then when you need to wait until it drops, then until it like consolidate, they suddenly become very slow at the bottom. Then you can consider to do an entry there. Or if you want, this is how we get a very high risk reward um, trade. However, if you still want to use a normal 1 to 2 or 1 to 3 retails trade concept, you can wait it breaks all the way, then it comes back to above the previous stop loss, then you entry again, and then the stop loss will be the low of the low of the recent low, then the target will be the directions. Institutional traders always stop loss most of the people before it move to a directions because they don't want to let the people earn, because when people earn they lose money. When people lose money, they earn the money. In the market, it's the zero sum. So I hope I answer your questions, Jake Go. Did I answer your questions? Yes, we always have to look at the volume. You will notice that my advice is wait the market suddenly at the let's say you notice there is an important support area like the double top or double volume, double top or any famous every like the very easy spot retail patterns cut loss, then you always monitor that. Then suddenly when you see a very like very active drops, it keep breaks. You just have to wait until it will slow down, and you got chance to get in at the low one, because many people is afraid to enter already, but that time is the best time to enter. All this confidence you need to keep on back testing and always look at the market, always study the market, then you got the confidence to trade like this. So this is just an idea, and then you have to look back at the markets and how you trade in order you have confidence to do this trade. The volume will be suddenly become very big at the low, and volume is always the important one. Then many people say big volumes breakdown or breakout, big volume breakdown is very bearish, right? Usually by that time is the time the institution traders they load their orders, provided that the high time frame is very bullish. So you need to apply the high time frame bias too. But trading professionally actually is not that easy, and this is just a small part of it because you need there's a lot of other stuff. But for these chart patterns, you all can increase your win rate in trading already. All right. Oh, okay. I think today I think almost time, and you all can consider use my Usmart. Sorry. Usmart invitations code or QR for the Hong Kong. Left side for the mid one will be the Singapore apps. And you all can, if you want to reach out to me, you all can consider to add my WeCom, which is WeChat. Can use WeChat to add me at my WeCom. All right. If not, maybe you all can consider to join my Telegram. Sorry. But somehow my group is not that active. I just open it and I see if there is any people join. All right. So don't be shy to reach out to me, and I hope my sharing sessions today can be very benefit you all in the trading journeys. So keep study. In the markets, you need to study. Always study, always backtest to have a confidence. All right. So thanks for joining today. I hope you all learned something. And next, this is the disclaimer. Okay. Have a nice day, everyone. Oh, sorry. All right. Okay. Have a nice day, everyone. See you all.